Have you ever wondered, in this age of digital finance, what happens to your hard-earned money if the platform you trust suddenly vanishes? We're talking about a scenario that keeps even the most seasoned investors up at night, the collapse of a financial institution. Specifically, what would happen if M1 Finance, a popular platform known for its automated investing, borrowing, and banking features, were to collapse? It's a disquieting thought, isn't it? In a world increasingly reliant on fintech companies for our financial well-being, understanding the worst-case scenarios and, more importantly, the safeguards in place isn't just prudent, it's essential. We pour our savings, our investments, our hopes for the future into these platforms, lured by their sleek interfaces, low fees, and promise of financial freedom. But what's the real protection behind the digital facade? Are your investments truly safe, or are you just one market downturn or corporate misstep away from a catastrophic loss? This isn't about fear-mongering. This is about empowerment through knowledge. It's about demystifying the complex world of financial regulations and protections so you can invest with confidence, knowing exactly what safety nets exist. Because while the probability of a major, well-regulated financial institution like M1 Finance completely collapsing and leaving clients with nothing is incredibly low, understanding the mechanisms that prevent such a disaster is crucial for anyone engaging with modern financial technology. Think about it, M1 Finance has positioned itself as a comprehensive financial super app. You can invest in custom portfolios, borrow against your investments, and even manage your everyday spending with their cash accounts. This integrated approach is incredibly convenient, but it also means you're entrusting a significant portion of your financial life to a single entity. The question then becomes, how resilient is that entity, and more importantly, how protected are you if that resilience falters? We've seen headlines in recent years about smaller fintech companies facing challenges, even bankruptcy. While these are often not directly comparable to a regulated broker-dealer like M1 Finance, they do highlight the inherent risks of the financial landscape. The sheer speed at which digital platforms operate, combined with the interconnectedness of the financial system, means that understanding the what-ifs is more important than ever. So, let's peel back the layers. We're going to dive deep into the world of financial insurance, regulatory oversight, and the structural safeguards that are designed to protect your assets even if a company like M1 Finance were to experience severe financial distress or, in the most extreme scenario, collapse. We'll explore the roles of key organizations like the Securities Investor Protection Corporation, SIPC, and the Federal Deposit Insurance Corporation, FDIC, and how their protections apply specifically to M1 Finance's various offerings. It's not just about what happens to your money, it's about what happens to your investments. Your stocks, your ETFs, your carefully constructed pies, are they truly yours, or are they just digital entries on M1's ledger? And what about the cash sitting in your high-yield accounts? Is it treated the same way as your brokerage account? These are the critical distinctions we need to make to fully grasp the safety of your funds. Beyond the formal protections, we'll also touch upon the practical implications of such an event. What would the process look like for an M1 Finance user? Would you immediately lose access to your funds? How long would it take to regain control of your investments? And are there any proactive steps you can take today to further diversify your risk and ensure greater peace of mind? The goal here is not to scare you away from innovative financial platforms, but to equip you with the knowledge to make informed decisions. M1 Finance, like many other reputable fintechs, operates within a regulated framework. However, understanding the intricacies of that framework is key to truly feeling secure about your financial future. Let's start with the cornerstone of protection for investment accounts, the Securities Investor Protection Corporation, or SIPC. If you have an M1 Invest account, this is your primary line of defense. The SIPC protects customers of its member broker-dealers up to $500,000, including up to $250,000 for cash. It's important to understand that SIPC protects against the failure of the brokerage firm, not against losses in the market value of your securities. So, if the stocks you own go down in value, SIPC won't help you. But if M1 Finance were to collapse and your securities were missing due to fraud or administrative breakdown, SIPC would step in. M1 Finance is a member of SIPC. This is a crucial point. It means your investment accounts are covered. But how does this actually work in practice? If M1 Finance were to go out of business, your investments, the actual shares of stock or ETFs you own, are generally held by a custodian, not M1 Finance directly. For M1, this custodian is typically Apex Clearing. Apex Clearing is another regulated entity and also a SIPC member. So, even if M1 Finance ceased to exist, your holdings would still be with Apex Clearing. You would then be able to transfer those holdings to another brokerage firm. While this process might be a hassle and could take some time, especially if you have complex holdings or are utilizing margin, your underlying investments are still safe. Think of it like this: M1 Finance is the storefront, and Apex Clearing is the warehouse where your actual goods, your securities, are stored. If the storefront closes, you can still go to the warehouse to retrieve your goods, or have them shipped to a new storefront. Now, what about the cash components of your M1 Finance account? This is where the Federal Deposit Insurance Corporation, or FDIC, comes into play. The FDIC insures deposits in banks up to $250,000 per depositor, per insured bank, for each account ownership category. M1 Finance offers M1 cash accounts, including their high-yield cash account. M1 is not a bank itself, but it partners with FDIC-insured banks to hold your cash. For example, M1 cash accounts offer a significant amount of FDIC insurance through a network of partner banks. This can be as high as $3.75 million and even up to $4.75 million or $5 million depending on the specific program and recent updates. The key here is that your cash is swept to these underlying FDIC-insured banks. Until the cash is swept to partner banks, it is held in your brokerage account and protected by SIPC. Once the funds are swept, they are no longer held in your brokerage account and are then protected by FDIC insurance at the partner banks. So, if M1 Finance were to collapse, your cash held in these swept accounts would be protected by the FDIC up to the stated limits through their partner banks. It's vital to differentiate between M1 Finance as a broker-dealer and the underlying banks they partner with for cash accounts. The FDIC protects against the failure of the bank where your cash is held, not the failure of the fintech company itself. However, because M1 sweeps your cash to a network of FDIC-insured banks, the protection remains in place. With that said, thanks for watching, and until next time.